I'm going to be talking about trading when the market is in a bear channel, which happens a lot. I'll first define what I mean by a bear channel, and then I'll talk about ordinary common types of bear channels. And then there are different variations of bear channels. One where the channel is especially tight, basically a small pullback bear trend, where the pullbacks are very small, very brief, and the market keeps trending down. And then broad bear channels, which are basically trading ranges that are tilted somewhat down. All right, so I'll start with what is a bear channel. And it's a series of lower highs and lower lows. And not every high is necessarily going to be lower, and not every low is going to necessarily be lower either. But as long as overall it's starting in the upper left and going down to the lower right, and it's mostly lower highs and lower lows, it's a bear channel. And every bear trend begins with some kind of a bear breakout. Sometimes the breakout bar is relatively big, conspicuous like this, and sometimes it's very small. And that bear breakout represents bulls giving up, bulls deciding that the price is too high, they better get out and look to buy back lower. And it's also bears selling aggressively. Every trend bar I see on a screen, I think of as a breakout. But I typically reserve the term breakout for trend bars that have a reasonable chance of leading to a trend. And a breakout, it can be a single bar, it could be two bars, it could be many bars. I just want to see some bars that are big relative to the prior bars, and I want to see bars closing near their lows. Here we have two bear bars, and it's right on the open. It's a bear trend from the open, and the second bar is surprisingly big. And whenever you see something that is surprisingly big, you have to expect at least some follow through. In other words, some second leg. Sometimes it's just a single bar like this, sometimes you get more of a pullback, and sometimes you get a second leg, a third leg, and it just keeps trending down all day. But when I see a bear surprise, I expect at least a small second leg down. And trends usually begin with surprises. This is the breakout. Here it's two bear bars, it could be one bar. And as soon as I see a bar go above the high of the prior bar, the breakout phase has ended, and that is a pullback. So a pullback simply means a bar goes above the high of the prior bar. Sometimes it can last 2 or 3 bars, sometimes a pullback can be 4 or 5 bars. But once you get a pullback, the breakout phase has ended and the trend has become weaker. And now it's in a channel phase. And the channel can last a few bars. It can have a big pullback breaking above the bear trend line and form a bigger channel that can last all days. Every bear channel is some type of spike and channel pattern. Here we have a spike and a wedge bottom, yet it continued down into a much bigger channel. And a channel typically has at least 3 pushes down, 1, 2, 3. So a channel, wedge, usually I use the term synonymously. When you have some kind of a wedge, 3 pushes down in a channel, it typically begins to attract some profit taking. And that's when this is an example. And sometimes the profit taking is enough to reverse the trend. Sometimes the profit taking has a couple legs and then the trend resumes. I don't have the bear trend line drawn in, but we broke above the bear trend line, yet we could not get above prior lower highs, and the reversal was minor and it became a bear flag. All right, so when the market's in a bear channel, it's a bear trend, and it's a lot easier to make money selling than it is buying, especially if most of the bars are below the moving average. And you see it keep trying to get above the average price. And when people start to think that the average price is expensive and they keep selling at the moving average, it doesn't matter if you get strong rallies to the moving average. If you see it constantly failing at the average price, you have to assume it's going to be a lot easier making money selling. These red boxes are reasonable entry places. For example, if you get a reversal up, here we have a bull bar, and then you get a bear bar closing on or near its low, it's reasonable to sell on a stop below that bear bar. Here we have another reversal up and another bear bar closing on or near its low. You sell on a stop 1 tick below that bar. Here we have 3 bull bars. The bodies are increasing in size, so the momentum is picking up. Yet, what happened? As soon as it got to the average price, the body started to shrink, and then you get a bear bar closing near its low, another sell. If you place a stop to go short right below that bear bar. And you just keep doing that all day long. As long as you keep seeing bear bars closing on or near their lows, this is a special circumstance. It's an inside bar, another small bar at the moving average. I would sell that. But you could sell below that bear bar, below this bear bar, and you can just keep doing it all day long. You can take profits at the prior low, or you can take profits after it makes a new low and then reverses up. You exit above a bull bar. If you take this sell, you could put a stop here, or you could put a stop up there. If you take this sell, you could put a stop here. You take these stops. If you enter on these stops, you have a double top bear flag. I'd put a stop either above that or above that. And then you just take profits on a reversal back up, where you simply hold all day, and after each new pullback and each new low, you just tighten your stop. I typically get out above a bull bar. So if we make a new low and I think the day is in a bear channel, this green box is a buy. In that particular circumstance, you could buy for a scalp, but at a minimum, if I were short, I would get out. We have a bull inside bar. It's actually an outside bar, inside bar, so it's an I pattern. You're probably going to get a couple small legs up. Here, 1, pullback, and then 2. And if you're buying in a bear channel, and the channel is tight like this, the reversal is probably going to be minor and lead to either a trading range or a bear flag and not a bull trend. So if you're buying in a bear channel, you're buying for a scalp. You're just looking for a quick profit, maybe a point or two, maybe a test of the moving average. Now, there are things to look at on a chart that tell you that it's mostly better only to look to sell. For example, here, what do you see? All the bars are below the moving average. That means you have to expect the market is going to keep working lower, and therefore it's going to be easier to make money selling. And then you get pullbacks that are racing up to the moving average, but they're stopping at or around the moving average, and the market's starting to resume down again. And then pullbacks do not last very long. Here, we went up for a couple bars, here for a couple bars, here for 3 or 4 bars. And then you look at the bull bars. How big are the bull bars? How many consecutive bull bars are you getting? Are you getting bull bars closing near their highs? Are you getting bull bars breaking above the moving average? Are you getting 2 or more bull bars breaking above the moving average? Here you have a pair of pretty good bull bars, 1 bar closing above the moving average, but that's it. You don't get consecutive bull bars closing above the moving average. And then you look at it and you say, okay, if I take a stop entry buy, most of the time I'm losing money. If I buy above this bull bar, I lose money. I buy above this, it's hard to make money. If I buy here, possible bull flag, possible bull trend, possible higher low, major trend reversal over bull flag, very hard to make money. So if most of the stop entry buy signals are losers, that tells you that it's going to be a lot easier to make money looking to sell. And then in a very strong trend, I'm looking at whether or not pullbacks go above breakout points. And if the pullbacks do not go above the breakout points, then traders buying with limit orders cannot make money. And that means it's a very strong bear trend. Okay, if the pullbacks are big, so here we have a breakout. We have a big trend bar. We have a new low, so it's a breakout. Here's the breakout point. It broke below something. It broke below this. And at some point, you're going to get a pullback. Does the pullback go above the breakout point? That's a really important point. If it does, that tells you that some bull who had a limit order to buy at this low, he gets filled here, he uses a wide stop, and he buys more lower, he made money. So he bought at this low, he bought more lower, and then it got back to the breakout point, his original buy. He could get out break even on his first buy and with a profit on his lower buy. So that tells you that limit order bulls buying with limit orders at prior lows and belows are making money. I call that a stairs type of pattern. And when you're in a stairs type of bear channel, bulls can make money in addition to bears making money. but it's still easier to make money as a bear. Plus, the profit that you make as a bear is bigger than the profit that you'll make as a bull. Another example, we have a breakout here to a new low. So this is the breakout point. The market pulled back and it went above the breakout point. And therefore, limit order bulls. Once bulls start to see pullbacks going above breakout points, a pullback going above breakout points, you'll get limit order bulls buying below lows, confident that even if the breakout is strong, it'll come back above that breakout point and they can make money if they take the buy and scale in lower. All right, so some bulls buy at the prior low, they buy more lower, maybe a point lower, maybe 2 points lower, buy more again, confident that it went above breakout points here and here, it'll probably do the same here, and then they can get out break even on their first buy and with a profit on their lower buys. A series of bear bars, so it's a breakout. Is this a pullback? Well, in this time frame, it's not. On this time frame, it's a pause. Remember, a pullback means the next bar goes above the high of that bar. So to me, this is a pause, and this is a breakout. And the breakout phase ended when this bar went above the high of that bar. So this is the end of the breakout right here. And when the breakout phase ends, the channel phase begins. So we have a spike down, a bear breakout, and a pullback. And now we're probably in a channel. Channels typically break to the upside. Bear channels typically break to the upside. Every time I see a bear channel, I think of it as a bull flag, because 75% of the time, you're going to get a break above the channel and then a transition into a trading range. So typically, you get a strong trend, a breakout, a channel, and then a break above the channel, and then a transition into a trading range. Okay, so I said this is a pause and not a pullback. On a smaller time frame chart, there might be a pullback, but on this chart, it's just a pause in the breakout, and the breakout is continuing. And then once a bar goes above the high of the prior bar, you have a pullback. Couple legs up, one pullback, two, and now we have a big bear bar. So we're probably beginning a channel down. Traders will start to look to sell. And as I said, 75% of the time, you'll eventually get a break above the bear trend line and a conversion into a trading range. And then you start trading it like a trading range. Sometimes you have a bear channel, and instead of breaking above the channel, you break below the channel. So you break below the bottom of the channel. And when that happens, 75% chance within 5 bars, it's going to reverse back up. So only rarely do you have a bear channel that breaks below and you continue down into a stronger bear trend. 75% chance it's going to reverse up. You still keep selling below bear bars, closing on or near their lows, but you exit above a bull bar. Another way to exit is a certain number of ticks above a bear bar, 4 or 5 ticks above a bear bar, just in case this bull bar becomes a huge bull bar. You don't want to be risking too much. So the market crashed down, reversed up, and odds are you're going to get at least a small second leg up after a bull breakout. A bull breakout, bull reversal, you'll probably get at least a small second leg up. Here's a bear channel. It's a small pullback bear trend, and we're breaking below the bottom of the channel. 75% chance the breakout's going to fail and the market's going to reverse up. That means 25% chance the breakout's not going to fail and it's not going to reverse up. So 25% of the time, you'll get a breakout below a bear channel and it begins the process over again. So instead of a bear channel and then a transition into a trading range, you get a bear channel and then another breakout phase, and then you're back into a breakout and bear channel situation. Bear bar, we've got a breakout bar. You can sell below the low of the bar, sell below the low of the bar. You're getting bear bars closing on or near their lows. It's reasonable to sell on a stop 1 tick below the low of the bars. Here we got a pullback and then a bear bar closing near its low. Every time you see a bear bar closing on or near its low, it's a reasonable short 1 tick below the bar. And you don't have to take every one of these shorts, all right? A lot of times it happens quickly and you don't expect it. When you see this breakout, you're thinking, well, Al says 75% chance it's going to reverse up. Maybe I shouldn't sell. It's reasonable to take the sell, and then if you get the reversal, get out, because sometimes you'll get a big trend down. And after 3 or 4 bear bars, if you're still flat, you're thinking, oh my gosh, I'm missing something. What do I do? How do I get in? What you do is you simply place an order to go short 1 tick below any bear bar. You could wait for a pullback and then start. But when you're in a strong bear trend like that, you have to get short. And the easiest way to do it is wait for a bear bar closing near its low, and then enter on a stop 1 tick below the bear bar. Bear channel, 3 legs down, 1, 2, 3, and a pretty good looking bull bar. Late in a bear trend, you're probably going to get some profit taking late in the day. So I would get out of shorts above that bull bar. And in fact, I personally would buy, looking for at least a couple legs up, some profit taking, at least to the moving average. Now, 4 types of channels. And there are some subtle differences here between this channel and this channel. I don't know if you can see the difference, but in this channel, we have bull bars, but no bar goes above the high of the prior bar. So I call that a micro channel. And it looks similar to this, but it's not. It's different. This is a micro channel. There are no pullbacks. And on the next higher time frame chart, let's say this is a 5-minute chart. If you look at a 15-minute chart or a 30-minute chart, you don't have any bull bars. It's just a series of bear bars. So a micro channel is the strongest type of bear trend, and you only want to sell. And the next strongest type of bear trend is this. It's a small pullback bear trend. The pullbacks are small, 1 or 2 bars, and you keep making new lows, and the pullbacks do not go up very far. So they're small and they're brief. And whenever you see the market looking like this, don't buy. You only want to sell. So a micro channel, you only sell. A small pullback bear trend, you only want to sell. And on a higher time frame, this is going to be a breakout as well. It'll just be a series of bear bars. If this is a 5-minute chart and you were to look at a 15-minute chart or a 30-minute chart or a 60-minute chart, you wouldn't see any bull bars. You'd just see a series of bear bars closing on or near their lows. And if the next higher time frame is a strong breakout, on this time frame, you don't want to be buying. And this is a common type of bear channel where you have pretty good bull bars, pullbacks lasting more bars, 5 bars, sometimes more. You have the market going sideways for extended periods of time. It's good to sell reversals down from the moving average. Every time it rallies to near the moving average, you sell on a stop below a bear bar. However, bulls entering with stops can make money as well. Buying above this bull bar, buying above that bull bar, they can make scalps. So in an ordinary type of bear channel, yes, you keep selling, but if you want, you can also buy above reasonable bull bars reversing up from a new low. But you're buying for a scalp, expecting the market to fail at or around the moving average. Limit order bulls, they'll make money. So bulls buying with a limit order at or below the prior bar, they will make money. Here, buying at this low or below, you'll make money because you'd expect the pullback to come above the breakout point. So stop order bulls, bulls buying with stops, limit order bulls, bulls buying with limit orders are making money. And that is common in a bear channel, a common type of bear channel. Easier to make money selling, but you can start to make money buying as well, buying for scalps. And then a broad bear channel, when you look at it, at this point, is it a bear channel? Well, it has lower highs. Is it a trading range? Yes, it's clearly sideways. Is it a bull trend? It might be. We have a higher low, and this high is above that high, so it might also be a bull trend. And whenever you see a channel that is very broad, where the rallies go almost all the way up to the prior high, it's basically a trading range that is tilted down. And when the market's in a trading range, I'm looking to scalp. I want to buy low, I want to sell high, and I scalp. You can say, well, Al, it's a bear trend. Don't you only want to sell? Well, when you look at it, at this point in the day, right here, at this point in the day, you wouldn't be calling it a bear channel. You'd be calling it a trading range. And if the market's in a trading range, I want to buy and sell. and I'm going to be scalping. Most of the bars below the moving average through here, easier to make money selling, but now we're starting to get a lot of bars above the moving average. You'll get bulls buying. All right, bear channel. You got a spike down and then a channel. You have a pullback and a channel. You sell rallies. Anytime it gets near the moving average, you look to sell below a bear bar closing near its low, especially if you have a second sell signal. Here's a first sell, and we have a bear inside bar, and then a second sell. Another, a small double top. This would be a second sell. Another double top. I know you can look at this and say, Al, it's not a double top. It's a double top. This was an attempt to get above that, and it reversed down a second time. A lot of times double tops are not perfect, and the second high can be pretty far below the first high. It can be above the first high, but it's still a double top. And we're mostly below the moving average. You want to be selling below bear bars closing near their lows. Another double top. This high went a little above that high, but it was simply a test of this high, and traders will look to sell. You could sell below the outside down bar, or you could wait for a second sell here. Here we have a bear inside bar closing near its low. We're still near the moving average. We're still in a bear trend. Sell below bear bars. Here, you could sell below this bear bar and take a chance that we go further down. And sometimes it doesn't. You simply get out one tick above a bull bar. Or if you want, you could get out 4 or 5 ticks above the bear bar and then look for the next sell. All right, so we went to a new low here, but we went above the breakout point. New low here, went above the breakout point. So we're stair-stepping down. Pullbacks are going above breakout points. And when that's the case, bulls will buy reversals up looking for a scalp. So maybe you buy above this and try to get a 1-point scalp to the moving average. Here we got a second reversal up. Here's the first, and then another pullback, and then a second. A reasonable buy. Even though the bull bars are not big, we're stair-stepping down. Every time it goes to a new low, it rallies. New low, it rallies. So you'd expect a rally. You might not want to buy the first reversal up here after 4 bear bars, so you might not buy above this, but this is a second attempt to reverse up, so it's a reasonable buy. Sometimes wedges grow and become bigger, and this became a bigger wedge. So we had a wedge here, we had a wedge here, and now we have 1, 2, 3, a bigger wedge. So nested wedges, that's a higher probability that we'll get some kind of a reversal up. Another wedge here, 1, 2, pause, 3. So we're probably going to get a couple legs up, reasonable to buy. So even though it's a bear channel, traders can buy as well as sell. Now I said bears will sell when it gets up to the moving average and reverses down. Lower highs, lower lows, bear trend. The bears, they do not have to buy back their shorts at a new low. They can continue to hold and just keep tightening, lowering their stops. So if you sell here, you could put a stop up there. A new low here, you could hold short and put a stop above the prior high. That's a major high. And as long as it keeps holding below the prior major highs, the highs that led to new lows, it's a bear channel. So a trader might sell for any reason here and just hold short and put a stop up here. Once it gets a new low, lower the stop. So you can swing trade. When I see lots of reversals like this, I tend to scalp. I tend to sell. It gets a new low, I take my profits. And if I get a reversal up from a new low, I tend to buy. So I tend to sell and buy and sell and sell and then buy again. All right, so here we have a breakout. We have a series of bear bars. We have 4 bear bars here. We have 7 bear bars in the past, 9 bars, bear bodies. It's a breakout, but it's not a very strong one. We have 1 bear bar and then a bull bar. We have 2 bear bars, they're not big, and then we have a bull bar. We have 2 bull bars here, but tails below. We have a bear bar here, but follow through is a bull bar. So it's a breakout, but it's a weak bear breakout. It still could be the start of a bear trend. Compare that bear breakout to this bear breakout. And what do you see? You see no bull bars. You see bull bars closing very close to their lows. You see bear bars getting bigger in size, body bigger, body bigger. You see bear bars closing on their lows or near their lows. This is a much stronger bear breakout, and it's more likely to be leading to a bear trend for the rest of the day. Sell below a bear bar, or you can wait until we're getting clearly a series of lower highs and lower lows. And once you see that, you have to bet it's going to go lower, and it might go lower all day. Anytime you get a reversal up, you have to bet, you got to bet the reversal is going to fail, and we're going to get a new low. So you get a reversal up, you see a bear bar closing on or near its low, you sell, you sell. You just keep selling below bear bars, reversing down. Now, you have a very strong bear breakout, and you're getting lower highs, lower lows, you're in a bear trend. What happens when you see a bull bar trying to break to the upside? Do you think that bull bar is the start of a bull trend? Or do you think, it's probably going to fail? Right? Every time you buy, somebody else is selling, right? So that means when you see a bull bar like this, closing on its high, somebody's buying and somebody's selling. Which one do you think is going to make money? The bear's going to make money. And therefore, if I see a bear trend like this, and I see a bull bar with a good-sized body closing on or near its high at the moving average, what am I going to do? I'm going to sell, all right? So here you have a very good bull bar, another very good bull bar, another very good bull bar, and I'm going to be selling them. So as soon as those bars close, I'm going to either sell at the market, or I'm going to place a limit order to sell at the close of the bars. It's counterintuitive. You see a bull bar, and you're hoping that the bulls are going to win, but they're not. They're going to lose. So here you get bull bars. They're good selling opportunities. You're not getting consecutive big bull bars closing above the moving average. You're getting weak attempts to get above the moving average. So another way to enter is, in addition to selling with stops below bear bars, you can sell the close of bull bars at or just below the moving average. Another thing to do is, traders are going to see the average price as expensive. The bulls who bought, they're not expecting a bull trend, and they're going to be trying to exit around the average price because they're expecting the average is going to keep getting lower. And the bears think that the average price is expensive. So the bears will sell around the average price as well. So another way to get short is you simply place a limit order to sell at the moving average, or maybe a tick below the moving average in case it doesn't quite get to the moving average or doesn't quite get above the moving average. So it's a third way to sell in a bear channel. Gaps are closing. We have a breakout, and that means it broke out of something. Look to the left, it broke below this. And then we have a pullback, and the pullback went above the breakout point. Even though it's a very strong breakout, the pullback went above the breakout point, right? What does that tell you? It tells you that a bull who placed a limit order to buy at this low, he got filled here. If he was willing to buy more, a point or two lower, and use a wide stop, he was able to make money. So he takes the buy there, he buys more down here, it gets back to his entry price. Yes, it immediately sold off because all the bulls were happy to get out, break even, the bulls who bought over here. But if he bought more lower, he made money. Here we have a breakout, series of bear bars. It broke out of something, it broke below this, look to the left. And then look at the pullback. It went above the breakout point. And that happened all day long. And therefore, the gaps are closing. The gap between this close and the breakout point, it closed. So bulls see that, and bulls are buying at prior lows and lower and making money. So the bulls will scalp. For example, they'll buy, and then they'll scale in and buy more lower. Buy 1 point lower, 2 points lower. Buy at the prior low and buy more 1 point lower. Buy at the prior low, buy more 1 point lower. Buy more 1 point lower, 2 points lower. Confident that there'll be a pullback that will go above the breakout point, and that will allow them to get out break even on their first buy and with a profit on their lower buys. So, and they exit on these blue rectangles once it bounces back to the breakout point. So when you're in a bear channel that is stair-stepping down, pullbacks going above breakout points, you can buy and make money even when the sell-offs look very strong. So that's another way to make money in a bear channel. The pullbacks are relatively small, and if the pullback is going to be small, 1 bar, the bulls cannot make much money, but they can make money. So if you want, you can buy prior lows and scale and lower and scalp for money. A lot of times, if you have a lot of two-sided trading, a lot of bull bars, bull bars, bull bars, a lot of reversal attempts, and it's in a bear channel, you'll get some profit taking late in the day, the final hour and a half. Bulls making money, betting that breakouts will pull back above the breakout point. And plus, you're getting bad follow-through, bear bar doji, bear bar doji. Whenever you see that, a big bear bar doji, bear bar bull bar, whenever you see that, when you see bad follow-through in the way down and a lot of prominent tails, that indicates that the sell-off has a lot of buying going on. And therefore, it's more likely to be a bear leg in what will end up as a trading range. Sometimes you do not get a bull leg in the trading range until late in the day. But whenever I see this kind of a sell-off with bad follow-through after the bear bars and a lot of bull bars and then a lot of bars with prominent tails, that's a very two-sided market. And the odds are you're going to get some profit taking and some conversion into a trading range later in the day. You do not typically get that, but you do get some kind of a rally. Maybe the opposite of this. So a weak sell-off and then a weak rally. Sometimes you'll get very sharp profit taking like that. So when you have a weak sell-off, bear bars having bad follow-through, lots of bars with prominent conspicuous tails, you're probably going to get profit taking. So you have to be looking for a reversal late in the day. Here we try to get a wedge bull flag. Here we try to get a wedge bottom. Here another wedge bottom. 3 consecutive attempts at a wedge bottom. Usually you're going to get some kind of a reversal. So you're looking to buy a reversal up, buy above a bull bar closing on or near its high. Breakout far above the bear channel. It's now, and always in long market, it's probably going higher. And a bear bar late in the day like that, I would get out of my longs below any bear bar. So I'd get out of longs there. Tight bear channel. Okay, very tight, not much overlap between the bars. Pullbacks are small. This is what I mentioned earlier, that sometimes you get a perfect double top. Sometimes you'll get a double top where the second high is a little bit higher or a little bit lower. But we have a bear trend here, a reversal attempt, a second reversal attempt, both failing around the same price, double top bear flag. And you could also call it a double top major trend reversal, lower high major trend reversal. We had a bull trend. Who knows what took place yesterday, but we're above the moving average. And we have a reversal down, and we have a double top, and it's a lower high. So it's a double top, lower high major trend reversal. And if you have a situation like this where you think you're in a bear trend and you have a double top, and then you get a bear bar around that double top, as soon as you see a bear bar, something mathematically interesting takes place. There's a 40% chance that if you sell below a bear bar at a double top in a possible bear trend, that you're going to break below the neckline of the double top. We have a double top, neckline. 40% chance you'll fall below the neckline for about a measured move down. Here, it ended up falling much lower. Okay? Now, are limit order bulls making much money here, buying below that low? No. It's a very tight bear channel. It's a small pullback bear trend. In 10 bars here, we've had one pullback, and it's only one tick. This is an extremely strong bear trend, and it's impossible for bulls to make money. If the bulls cannot make money, you have to be short. You have to be selling for any reason. It's not a strong bear trend in here, but now we're starting to get, here we got 4 consecutive bear bars. We have a 1-tick pullback. We have 6 bear bars, no pullbacks. It's a small pullback bear trend, a very strong bear trend, and therefore you got to be selling. Again, it continued down for the rest of the day. The pullbacks are all small. They're all brief. Here, it went up for 2 bars, not very far. 1 bar. Couldn't even go up here, right? Small pullback bear trend. It's a very tight bear channel. You only want to be selling. Anytime, and how do you get short? You see it happening and say, oh my gosh, I can't make money buying. I got to get short. How do I get short? Easiest thing to do is look for a bear bar, especially a bear bar closing on or near its low, and then place a stop order to go short 1 tick below the low of the bear bar. You want to bet on trend resumption down. When the trend is really strong, and let's say you've just watched all of this happen, and you said, this is what Al calls a small pullback bear trend. It's going to go lower. I have to get short. What do? You can just simply sell at the market. If you sell at the market here, you can put a stop above this, a couple ticks above that, a stop above that. Just sell at the market. And if you're really nervous, go to Walmart. Place your order, place your stop. Go out for a walk and come back in a half hour. Right? I talk about that in my chat room all the time. That if you find yourself unable to stay in a position, but your mind tells you that it's a good trade, just go out and come back in 30 minutes. Go out and do an errand. Go to Walmart. Do something. I'm sorry, what?
Go to Costco.
Costco, anything. Just get away from your computer, because it's a small pullback bear trend. It's a breakout on a higher time frame. It's going to trade lower for at least an hour or two more, maybe all day, and you don't want to be scared out. Oh, here's a bear reversal. We got a tail on the bottom of the bar. It's reversing. I got to get out. No, you don't get out. You stay short. Okay, a small pullback bear trend. Now, you may not get. Remember, I talked about in a regular bear channel how you sometimes get big bull bars at the moving average. Yeah. I can't hear. Yeah, this is true for every time frame. If you notice, I don't have prices on the right and I don't have times on the bottom, and it's for that very reason, that it doesn't matter what chart, what market, doesn't matter what time frame, it doesn't matter. Daily chart, weekly chart, yeah. This is a 20-bar exponential moving average, but you don't have to use that. I had a friend I traded with online for years. He used a 34-bar weighted moving average, and I said, why are you using that? And he said, I've done all this testing and it's perfect. It doesn't matter. You can use any kind of moving average. Just get comfortable. You just learn how the market tends to behave around whatever moving average you use. All right. So I was saying that when you're in a small pullback bear trend, you're probably not going to get a lot of big bull bars closing near the moving average. You may not even get bull bars touching the moving average for a long time. So those other ways of shorting that I talked about in a regular bear channel, you don't get those opportunities when you're in a small pullback bear trend like this, all right? So you have to have other things to do. One thing to do, you sell below bear bars like you do with any bear trend. Also, you buy above bars. You sell above any bar, right? So anytime a bar closes, you place a limit order to sell at the high of the bar. All right? It's a small pullback bear trend. So the pullback will be small. It might last a bar or two, sometimes three, but it's going to be small, and it probably is only going to last one bar. So as soon as you think you're in a small pullback bear trend, you place a limit order to sell at the high of the prior bar. Another bar, place a limit order to sell at the high of that bar, betting that it's only going to go up a bar or two and the bear trend is going to resume. So you can sell below bear bars. You can sell at the market. You can sell at the high of the prior bar. And if you see a bull bar, sell the close of the bull bar. The next bar might not go above the high of the bar. Here we have a bull bar. Next bar did not go above the high of that bull bar. So you just sell at every bull close. These are all ways to get short. Broad bear channel. When the bear channel has pullbacks that go pretty much all the way up to the prior high or near the prior high, and you're looking at it and you're not sure, is it a trading range? Is it a bear channel? At the end of the day, you look at it and say, we have a bunch of lower highs. This high went above that high, but not above these highs. And this low is a little bit below that. This is a little bit below that. This is a little bit below that. At the end of the day, you look at it and it's a bear channel. But during the day, for most of the day, it's also a trading range. And when you have a trading range that is kind of tilted down, I trade it like a trading range. So I want to buy low, I want to sell high, and I want to scalp. Here we got a bull breakout, a pair of consecutive bull bars, but look what happened. A lower high and at the moving average, and the next bar reversed. Okay? At that point, am I thinking this is the start of a bull trend, or am I thinking it's not a bull trend? And if it's not a bull trend, you have two things left. One is a bear trend, and the other is a trading range. But with this much of a rally, if it is a bear trend, it's probably not going to be a strong bear trend. So that leaves you with a broad bear channel. Okay? So once it's probably going to be either a bear trend, a broad bear channel, or a trading range, you start trading it like a trading range. And when you get bear channels, broad bear channels, or trading ranges, there's one thing that happens all the time, and it's really hard if you're starting out, and that is the market often looks strongest right before it reverses down, and looks most bearish right before it reverses up. So here, look at the bull bars here, and then you get this bull bar. So you get the best looking bull bar right near the top. Here, two strong bull bars, but they were unable to get above the high. Here, a huge bull bar, unable to get above the high. It looks the most bullish at this point, but that's not, you don't want to be buying. We're still in the trading range or still in the bear channel. And here we have a huge bear bar, and you're thinking, wow, it's really bearish now. But what will the follow through look like? We're at the bottom of a trading range, and you have to realize that trading ranges are constantly trying to convert into trends. So near the bottom, you tend to get a big bear breakout, but you have to bet the breakout will fail. When you get near the top, you're probably going to be getting a strong bull breakout, and you're going to look at it and think, it's going to be breaking into a bull trend. Until it has clearly broken into a bull trend, you have to assume every breakout attempt up and down is going to fail. So channels tend to look most bullish right before they reverse down and most bearish right before they reverse up. Lower highs, lower lows, so it's a bear channel, but I would still look to sell when the market is high and buy when it's low. And sometimes the sell-off is really strong. When that's the case, we have three bear bars here. Instead of buying the first reversal up, wait for a second reversal up and buy there. Same here. You might buy that. If not, you could wait for a second reversal up or wait for 2 or 3 bull bars and then buy above the second bull bar. Way down like this, you're not sure. Is this bear bar a pullback from a new bull trend here, or is it a failed breakout and the start of a bear trend? Well, you could sell below it, or you could wait for a second sell. A double top, a lower high double top, a little bit of a wedge. Okay, so a double top, that means it's a second sell. You could wait for that. High 2, high 1, first reversal up, second reversal up. Here you get a wedge. Even though it's a first reversal down, it's a parabolic wedge. First reversal up, second reversal up above that bull bar. Another wedge. One other point about these channels is it's really frustrating because you're looking for textbook signals. You're looking for really good signal bars. You're not going to get them. One of the hallmarks of a trading range is confusion, and that means nothing ever looks right. You see bull breakouts, they reverse down. You see signal bars that they don't look quite good enough, right? That's just the nature of trading ranges. And if you're not comfortable taking the entries, don't worry about it, and just don't trade it. But every now and then you'll get one that looks pretty good. Here, a second reversal up, that's pretty good. It's probably not going to lead to a trend. It's probably going to be a leg in a trading range, so you take the buy and then you take reasonably quick profits. So I talked about 4 types of bear trends, bear channels. Very tight, no pullbacks, a micro channel, you only want to sell. It's a bear breakout on a higher time frame chart. The next strongest type of bear channel is this. The pullbacks are small and brief, only 1, 2, 3 bars, and they do not go up very far. And on a higher time frame chart, this is also a breakout. So if you looked at a 60-minute chart of this, it would be a series of bear bars closing on or near their lows. And if it's a strong bear trend on a higher time frame chart, on this chart, you only want to sell. So a micro channel, no pullbacks, only sell. A tight bear channel, a small pullback bear trend, only sell. And then your typical type of bear channel where pullbacks go above breakout points. It's easier to make money selling, but you can also buy. You can buy with limit orders or you can buy with stops on reversals up. And then finally, a broad bear channel where it looks like a trading range and it's in a trading range for a lot of the time. You can buy or sell. I began by talking about what a bear channel is, lower highs and lower lows. I then talked about the ordinary type of bear channels where pullbacks go above the breakout points and you can make money buying and selling. Next, I talked about very tight bear channels, either micro channels or small pullback bear trends. You only want to sell. And then broad bear channels, which are basically trading ranges that are tilted down, you can buy and sell. Okay, does anybody have any questions about anything? Yeah.
So, we not have two types of buyers, for instance, like at the bottom of a downtrend, and you have like an institutional guy who buys, he's scalping, goes up to the moving average. And the guy that's buying at the top of that moving average just before it reverses, that's a retail guy?
No, there are not enough retail guys out there. Okay? You know, you and I are totally unimportant. We cannot do anything. We cannot do anything that will do anything on that chart. All of us together could probably not make the market move, right? You know, we're just too small and insignificant. So what you're saying is, well, how the heck do you get? Who's buying up there, right? You get that bull bar closing on its high, right at the moving average. Somebody had to take that buy, right? My opinion is it's high frequency trading firms looking for one tick profit, right? So it gets, if you look at that bull bar closing on or near its high, if you looked at maybe a 1 second chart or even a tick chart, you might see 2, 3, 4 ticks up, right? A high frequency trading firm is going to see it went up with no pullback, up with no pullback, up with no pullback. It's going to keep buying. It's going to do exactly what I'm talking about, but they're doing it on a chart that is 1 tick instead of a chart that's 5 minutes. So, you know, it goes up. They're going to buy at the market until there's finally a tick down, and then they sell.
My question kind of gets to moving average, if you will. So we're sliding up on bear channel, we're sliding up to the moving average. Mathematically, you say it doesn't matter whether it's a 20 or 30, that kind of thing. Well, wouldn't it make more sense to say moving average that some guy would be using?
Well, every institution is using something different. You know, you have no idea what they're doing, right? And you just don't. To me, I'm just looking for some measure of what is average. And on the 5-minute chart, for me, I think the 20-bar exponential moving average works pretty well. But if you put up any other, you know, some people use a 10-bar exponential moving average. Some people use 15. Some people use simple moving averages, weighted moving averages. And they all are kind of about the same. Some, you know, sometimes on the 5-minute, on the 20-bar exponential moving average, you'll see the market reverse down from below the average. Other times you'll see it go above the average. Well, guess what? If you were using a 30-bar simple moving average, those might be perfect tests on some other moving average, right? So with my moving average, you know, sometimes it goes a little bit above, sometimes a little bit below. If you look at some other moving average, my imperfect touches could be perfect touches. So it doesn't matter which one you take, you know.